Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. So there's this data a few months ago, and can you guess what it is? It indicated that the annual inflation rate in the United States has jumped yet again to 7% per year. Because of this inflation, we know that Jerome Powell and the Federal Reserve are planning 3 interest rate hikes this year. Basically, they want to stifle the economy and slow business. But boosting interest rates has the consequence of making businesses and stock markets less appealing. Super safe government bonds, on the other hand, begin to look more appealing, and while a high interest rate environment does not necessarily indicate the stock market will fall, it does produce a lot more pressure on the stock market than a low interest rate. Investors are concerned because they have experienced significant gains in recent years. But they are concerned that when interest rates rise, those gains will not continue, and the opposite may happen. With inflation already approaching 7%, the doom and gloom narrative is starting to gain popularity in the media, making everything look a million times worse. It's difficult to avoid big negative headlines on these news sites these days because you can see them anywhere that isn't about inflation or the interest rates or the Federal Reserve. But all of this conversation, debate, and concern about inflation and interest rates suddenly reminded me of something Peter Lynch, the author of One Up on Wall Street, stated in 1994.
No one can predict the stock market. They try to predict interest rates. I mean, this is it. If anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate, with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it would be very useful to know what the stock market is going to do. It would be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that.
The video clip I've watched before about Peter Lynch served as a reminder. Every time I feel like I'm getting trapped into a market prediction zone, I would watch that video. That clip emphasizes how market predictions and interest rate estimations are constant in the stock market. The main topic of that 1994 discussion was whether the stock market would crash and what interest rates would be, and would it matter. So let me ask you if you've ever attended a finance or economics class where they talked about how interest rates were in 1994 and how that affected the stock market's long-term performance. Maybe no, because it was completely insignificant. The S&P 500 was at 460 points at the time, but now it's at 4,600 points. However, it's amusing that at the time, the problem was being discussed as if it needed to be resolved or investors would face doom and gloom. We're still talking about inflation and interest rates as if they're the most important part of the markets today. It didn't matter back then, and it probably doesn't matter today, or maybe you'll disagree if you're already in the market for the long term.
Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen.
That is the crucial message for investors and anyone worried about inflation, interest rates, or a recession. There are some things that would be nice to know, such as where the S&P 500 will be in a year or interest rates in 2 years, but you don't realize it, and neither does anyone else. Yes, inflation could run rampant, interest rates could be raised to 15%, and the stock market could crash by 30%, but you'll never know when that will happen. So as an investor, you must understand that the market would go down from time to time, as Peter Lynch stated. Nothing is sure. You must be aware that market losses happen, and the pandemic that happened, no one predicted that, and it caused the stock market to plummet by 30% at the start of 2020. Nobody could have predicted that their portfolio would be worth 30% less in just a few months. So as an investor, you must assume that these occurrences will happen and that they will surprise you when they come. So just be ready for that. Now you may begin to think more clearly about how to approach your investing. Now how to do it? One of these is to always keep a long-term mindset.
Well, obviously the market's gone up tenfold since I stopped running Magellan. So you make more money on the upside. The market's gonna be a lot higher 10 years from now, 20 years from now, 30 years from now. Trying to predict the market is really a waste. I don't know what it's gonna do. It can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you're gonna say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
So the market goes down, you won't see it coming, and it will sting you at some time throughout your investment career. So what are you gonna do now? Peter said that you're a fool if you're investing money that you need in the short term to make a quick profit in the market. You're a bad investor if you're investing money you need to pay rent, if you're investing money that should have been for your children's tuition, or if you're investing money for your forthcoming wedding. Because the market may go down in the short term, as I always mention in this video, we don't know when it will happen, and if it does, you're screwed. However, if you invest money you don't need and add to your portfolio on a regular basis over 10, 20, or 30 years, you should do well. And at the end of the day, in Peter Lynch's opinion, the solution to the question, how should you be investing under high inflation? And how should we invest during periods when interest rates are likely to rise dramatically? We should approach it in the same way that we approach investing in general. We approach it rationally rather than speculatively. Know that those horrible things will happen from time to time, and that you will be hit with it at some point. Whether it's during a period of high inflation and interest rate hikes maybe tomorrow or in the next 4 months. But who cares? Be rational and stay focused on the long term, and that's the simplest way to know you'll perform well in the market during these times. So it's all about your investment attitude. Don't get caught up in the news, speculation, fear, or hype.
So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is, and I'm ready for questions.
In conclusion, it will always be scary, and there will always be something to be concerned about, but all you have to do is own good companies and have a long-term mindset, and what happens with interest rates and inflation, and as well as the market's short-term performance, won't become that important. Those are Peter Lynch's advice, and thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.